Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 15th, 2016. It's 11:30 a.m. Eastern Time as I'm starting this video, and I wanted to go over the Nasdaq 100. And as I often like to do, we'll take a look at various time frames on both the NDX, which is the Nasdaq 100 index, as well as the QQQ, the tracking ETF, and then I like to often go through the top 10 components, the charts of the top 10 components real quick, because the Nasdaq 100 is such a top-heavy weighted index. Those top 10 components make up well over half the are responsible for well over half the returns in the index. So if you want to know where the Nasdaq's going and the stock market in general, you just have to know where the top 10 are going. There are also many of those names are also the top components within the S&P 500 as well, although they have just a more balanced weighting. There's still top heavy weightings in the S&P, but they're not as overly top heavy as the NDX. So that's why I really pay attention to those. All right, it's a long-term chart, a monthly chart. And what we have here is a trend line off the 1990 lows. This was a tech bubble, the dot-com bubble back in 2000. You can see that we've just come up and challenged those highs and failed there. Interesting how technical analysis works. You know, previous reaction highs, if you don't have any other price points, are always a resistance level when challenged. And so far, the Nasdaq has tried and failed to take that out and close above it on a monthly basis. You know, when you trade a monthly time frame, you want to see a solid monthly close above that to say that level's been taken out, and that hasn't been the case. So here's your trend line. You know, we had several reactions. Some of the things I like to see on trend lines. You know, I always say trend line drawing is more of an art than a science. It's not an exact science for sure, but you can see here we have reaction, 2 or 3 or 4 reactions there. And then, as I like to see to help further validate a trend line, is once it's broken, do you see prices just limp on through and cross back up, or do you see impulsive selling? In this case, we saw impulsive selling that further validated this long-term uptrend line. And since that point in time, we've just tested that trend line from below, and so far, you know, we've failed. You know, with a couple, I can probably drag that trend line up, modify it slightly, and capture all those highs. But you get the point. That's pretty much prices back testing that trend line. So it's interesting to note. And then I have some other trend lines on here. You know, we have one off the 2009 lows right here. Goes up. This one, we need to see this break. This is a minor uptrend line that already broke down. You can see how many reactions on the bottom of these candlesticks here, either the bodies and or the shadows, the tails. And then we broke down, we've been back testing below. So you have intersecting resistance levels here. You have a trend line being tested from below. You have those 2000 highs from early 2000. And then you have this uptrend line. It hasn't been visited until recently. Hasn't been visited until, you know, early 2009. But once that goes, I think you'll see a lot of the longer term trend indicators that I still have that are still bullish, you know, on I'm talking monthly and weekly time frames, but a lot of my shorter term trend indicators have already flipped to bearish. But again, we're trying to identify here. This helps identify secular bull and bear markets and let us position accordingly. And you know, a couple things to make note, things that we look at here, they work just as well on the monthly time frame as they do on the daily and weekly. You have remember, this was one of the most powerful bull markets in history. This was a bubble, actually, the tech bubble, the dot-com bubble. And you had persistent overbought readings. You had overbought readings in 2007. And, of course, we didn't have a single overbought reading, not even close, until the top of the bull market in 2007. So I often say overbought or oversold can become more overbought or more oversold. So that in itself isn't a signal. It's usually that cross down below, or in this case, what I like to see here, we have divergence. So we had an overbought reading, an extended overbought reading in this bull market, and now we've come in and put in negative divergence. We didn't even have divergence back here on these two tops. Now we have a negative divergence, which to me helps to confirm a very powerful lasting trend change, especially when these divergences are applied on the monthly chart. You can see it down here as well in the PPO. I'll zoom in for you guys. And you can see the PPO is in bearish territory, negative divergence. And so that's the bigger picture. Now let's zoom on down a little bit and go take it down to the weekly chart. and a lot of trend lines here. But there's, here's one. The NDX, unlike every other index, bottomed the Dow, the S&P 500, Wilshire, small caps, mid caps, if I'm not mistaken. Just about all of them bottomed in March of 2009, and that's really considered the beginning of the bull market, the end of the last bear market. The Nasdaq did bottom a little earlier, just by a hair in 2008. So you can draw that trend line off there, or off the 2009 lows. As you can see, I have one on each. And you zoom in, and I know this chart's a little busy. I just have some key levels here, but you can see that primary trend line off the purple trend line off the '08 lows, breakdown, back test. Then I had this alternative trend line. It has even more reactions among it, off it, and breakdown right here, back test. This was an intra-week, a little flash crash back then that we had in 2015, but we snapped back and closed above it, so that's not statistically significant, or it's not significant because the fact that it did close back above there. A weekly chart, all that matters is the weekly candlestick closes. And there it is, back test, back test, back test. Very powerful divergence, and again, this is what puts me in the camp where, going back to that monthly chart, I know there's those that are very bullish that are calling for some new super secular bull market, that this is a double top high, we break out, and then you're looking at a multi-year, maybe even decade plus, ginormous bull market. Anything's possible, guys. I'm open all possibilities, but I can just tell you, I absolutely do not see that in the charts. Even if we punched above there briefly in a little fake out, there's too much evidence, technical evidence, not to mention fundamentals, where valuation levels are and other things like that, how far we are into this cycle, that tell me that the chances of a breakout with a big move up, and I'm talking anything more than just a little temporary fake out, is very low. And if the charts change and the fundamentals change, and hopefully I'll change my opinion before there's too much damage done. But I see a big trend reversal coming. It is clearly priced in the charts, and a lot of other things that I look at. And here's that weekly chart. You can see I've talked about it, the divergent highs. That we've had divergences in the Nasdaq 100 and most other U.S. markets going all the way back from the beginning of 2014. These divergences continue to build. There've been a series of smaller divergences along the way. Each one has resulted in a very profitable correction to trade on the downside, and this one's just getting started. So that's the weekly chart on the NDX, and let's take a look at the daily. Okay, this is a daily chart. I've posted this one quite a bit recently. This 47.50 level, we'll call it says 47.49.50. We'll call that 47.50, give or take. These things, market's been trading through that level, but it's a pretty significant level. Comes in around that 2015 high, which at the time was an all-time, or not an all-time, but the multi-year high. This was all-time. We're just, as I showed you on the monthly chart, just challenging those 2000 highs, all-time highs. But you can see the chart pattern is very clear. Bearish rising wedge, confirmed with negative divergence, everything you want to see. Breakdown back test, prices rolling over. I pointed out this was a very bearish, big bearish engulfing candlestick recently, last week. So far, prices remain below that bearish engulfing candlestick. They're just now poking their heads above this 47.50 level, which is comparable to that 116 level that I talk about on the Qs, which we're currently flirting with right now. Intraday noise, disregard it. Volatility has been up recently. Most important thing is what happens end of day, and you can see the price action around that level recently. Look at this candlestick right here. So we have this candlestick. Let me grab an arrow tool here, color that white so you can see what I'm talking about. That arrow's a little big. You can see where the body or the bottom of that candle closed, the body there closed, that wick or shadow that was, or tail, that was an intraday break with a close back on that level. Here's a level down from where the body closed on and above. Remember, candlestick bodies are going to show you the close or reaction, so you can just see how well it's playing off. Now, today, that candle, we're splitting right through there. Who knows? Anything can happen, but I wouldn't be surprised to see the Nasdaq sell into the close and then close down on or below that 47.50-ish level. And like I said, there's a lot of evidence here in the charts, guys. A lot of evidence. There's a trend line here, an alternative trend line that was almost back tested on that big bearish engulfing candlestick. So Bullish case, the bulls have some work to do. There's divergences that still would have to be burned through right here to help, take, dampen the bearish case and firm up the bullish case. Most certainly, the bulls would have to reclaim that bearish engulfing candlestick right here, meaning get prices back above there to undo that action. It's not uncommon after a bearish engulfing candlestick to see prices trade below it for a few days before they finally, things roll over and start moving sharply lower. But as of now, this is bearish price action. Is it frustrating if you're short that the market hasn't rolled over completely? Sure, but it's not gone up either. And the QQQ trade is still well in play. They haven't taken our stops out on that yet, so that one still looks good in my opinion. Okay, that was the first half of the video where we looked at the indices, and I'll show. Maybe we'll look at the Qs real quick. Yeah, let's do that because I didn't cover QQQ. I know a lot of you guys trade QQQ, so it's a little easier than going over the NDX. But there's that one. This is one of many charts I have. Let's see. I have a couple boards. Forget about it right now. I have another board with targets. Let me see if I can. There it is. Okay. All right, that's where we pulled the stop. So far, a very good move. That was the day that stop clearing run with that bearish engulfing candlestick. I reinstated the stops back right after that day on to go back to a daily close above 117.50. So you can see we're comfortably below that level right now. Currently flirting with the 116 level. We're at 116.12 as I do this video. No big deal. Let's see where we close. And again, I'll leave the stops where they are for now. Market has no business being above there, especially the top of that. At the very most, if I do modify the stops, I would set it just above the top of that bearish engulfing candlestick, maybe on a daily close, which wouldn't be much higher. We're talking another less than one, not even 1% or so above the previous stop. But again, we'll leave it at that for now. So there's still a lot of profit potential, and I still think, to this point, the risk reward on this trade, as far as a broad market short goes, is just extremely attractive. You're talking from this level here, we're 116.10 now. If I can grab that level, if you stop above a daily close, maybe you're a little higher than the 117.50 level when we close. You're talking less than 2%, easily less than 2% on the downside for what could easily be. There's 5.5%. I could easily see the market going down here. There's 10%. And again, if those long-term charts play out, if all this starts to play out and this trade starts moving down, hitting these targets, I will most likely extend this because those weekly charts, and that's why I'm doing this video, the charts are stacked right now. There's bearish setups on the shorter term charts that lead out to the weekly charts. When you start seeing those weekly trend line breaks and the monthly trend line breaks, then you're talking you can tuck away a position for a trend trade that might be a drop of 30-40% or more over the next year or so. If that's how you're trading style, if you want to position short, or let's say you don't short the market, but you have money in a 401k, IRA. You've heard for years how this market can't keep going up, but yet it has, or at least it hasn't fallen. We've gone nowhere now for a couple of years. So where the value you might take from these videos is once these sell signals are confirmed, once the evidence is clearly pointing to the fact that we've begun now a new downtrend, a primary downtrend, that these support levels are breaking, the market's rolling over. That's where you may want to take out your 401k money that's been in the market, and move some or all of that into cash or bonds or whatever other options that you have available there. All right, so there's the Qs, and as of now, looking good. Okay, now we'll get to the top components. So what I have here is just a related items list. This is a watch list. It has all 105 stocks in the QQQ, and I have them sorted by market cap. So give or take, it'll give us a top 10. This should be, we'll go down to maybe Gilead here or something like that. Cover a few of these depending on the amount of time. Let's start out today doing the 60-minute charts, and we'll work our way out. All right, 60-minute, looking at a lot of these components, I have to say they look more bullish than bearish right now. They're certainly in near-term downtrends and have been. Just to kind of recap, all of these charts are not fully marked up, but I pointed out a lot of these before on various. I have different boards that I use. But on this board, we had a divergent high back here in Apple. You can see the negative divergence. These are the things I look for especially for swing trading opportunities. On the 60-minute time frame, you have these divergent highs, these divergent lows. So we have almost divergent. It looks about an equal low, maybe slightly lower low on the MACD right there. You can see if I pulled that line down just a hair. This thing's not letting me do it right there. You go. So really not exactly, if you want to split hairs, but very close to bullish divergence. You had a downtrend line here. Prices broke above it, made a low-level back test, and now you have this other alternative downtrend line. You also have a resistance level here. So Apple could pop here. If it does, let me tell you how much upside I see. Up to about this level, about that's a little shy of 112. Pretty solid resistance right there. That was former support. It was broken, back tested. So there's your upside in Apple, best case scenario. But again, we're going to keep in mind, I'm going through these charts. I'm going to start with the 60-minute charts, and we're going to work our way out. And the most important point that I can impress is I always give a higher weighting to the longer term time frames. In other words, what you see on the daily charts is more important than what you see on the 60-minute charts. What you see on the weekly charts are more important. By that, if you see a breakdown, let's say a confirmed breakdown on the daily charts of a key support level, and there was a bearish chart formation in play, but I had some bullish development like this on the 60-minute chart, I will ignore this 60-minute bullish development, because it probably won't play out. The daily charts will take precedence. So there's Apple. Like I said, I wouldn't be crazy to short it right here, nor would do I care to chase it long, and I'll show you why. All right, here's the daily chart. Let's clear. This is a lot of stuff. Ignore these. Just old past trades or things I pointed out on the chart before. Divergent highs and divergent lows and all this good stuff. This one's one of many boards. Most importantly, we had this recent series, two consecutive, or really one big divergent high. It was a series of two consecutive divergent highs, a little trend line break, and that one played out and it's hit. There's quite a bit of support. All these lines on this chart are support. This, as I pointed out past, was and still is critical support. We briefly snapped below it. That was a little stop clearing run. Those are very bullish. That proved to be bullish. And you can see that after that stop clearing run right there below that critical support level, came and back tested it, validated that level. It's pretty well defined support level, and I still maintain that as critical support. If and when that goes, especially on a daily closing basis, and you'll know it when you see it. You'll probably see some very waterfall sell-off in Apple if 92.50 goes. But until then, this one has quite a bit of support down below as well as resistance overhead. Recently broke down from this pattern. That may be all that it needs to play out. Because that was a pretty good move down. I'm talking in relation to the divergences that led up to it. That was a pretty hefty move down. But if it breaks, you can see there's support here. I don't have all the lines drawn. You can certainly add some more. And if you guys trade, I'm not right now trading Apple. I don't care to trade Apple at this point. I think there's more meat on the bone of some other trades. But what I did want to share with you guys are some of the longer term developments. Breakout and back test, that's just referring. I need to move that arrow over there. So what you have here recently is, this was a downtrend line, a falling wedge on the weekly chart, bullish divergences. That was pointed out at the time. Broke out, back tested it, exploded off after the back test. That was bullish, and that should have had some traction. I told you I had my suspicions about it. I pointed all this out, but I never put Apple on as a long, and they faded that. This is not healthy bull market price action. After such a beautiful, and again on a weekly chart, falling wedge, confirmed with bullish divergence, breakout, backtest, an impulsive move up following the backtest, and look what happened. They've already faded almost the entire big impulsive move off the backtest. That shouldn't happen in a healthy market. If Apple had legs, it should have took the reins and run from that. That's my opinion, just my humble opinion, folks. All right, so. And this is also indicative of a topping or turning market. When a trend does finally start to shift, the primary trend from bullish to bearish, what you will see is bullish chart patterns will either fail to play out at all, or if they do start to play out, in other words, you have a bullish falling wedge breakout, it'll get sold into a lot sooner than the expected measured target on that move. Just as with in a bull market, your shorting head and shoulders breakdowns, bearish rising wedges, you're going to have a much higher failure rate on those patterns, and the ones that do trigger an entry will tend to fall well shy of their downside targets. So that just keep in mind that you do see bullish and bearish chart patterns during bull and bear trends, but you want to try to align your trades. And so far, what I'm seeing here is when Apple could have took the reins and run, they didn't do it. They failed to do so. And there's some other important developments. I'm probably going to spend more time on Apple because it is, still considered the 800-pound gorilla, or one of the 800-pound gorillas in the sector. All right, so there's that. You also have down here, if you note this, the PPO, which I use on the weekly time frame. It does a better job than the MACD, is currently poised to make a bearish crossover. I could put up a histogram. I don't have it here, but you can go back in time. When you see these bearish crossovers, especially divergent highs, that often leads to is followed up with a downtrend. So there's a potential bearish development right there. Something else that I'm noting is, you see this red line here? This is the 40-week moving average, because we're on a weekly time frame. A 40-week exponential moving average is the same as a 200-day moving average on a daily chart. And that line is very significant. I've shared this before. Let me see if I can pull up this other chart for you guys. Okay, this is the same. This is an Apple weekly chart. Might be a little hard to see. I had to shrink it down. I have it on usually on a much bigger scale up on my monitors, and I'm shrinking it down for this video. I believe I have a live link to this chart on the site, but you can see this goes back to early 2003. The red line is that 40-week moving average, and I pointed this out before. You can stop this, screenshot it if you want. You'll see that 40-week moving average 40-week moving average has done a excellent job of defining bull and bear trends. By defining bull and bear trends simply means when prices are below, you're in a primary downtrend, i.e. a bear market in Apple, a drop of 20% or more. When you're above it, the trend is bullish. And there's been a couple whipsaw signals. Nothing's 100% in trading, but this one's done a very good job. And you can, again, go back, look at the crossovers, look how prices acted, how that level acted as support. Once prices were above it, every time it came and was tested, you see support, and you look for these weekly closes, and once broken, as it was back here, this doesn't look like much. I'm using a log scaling. That's why these numbers look compressed. That was a big drop in Apple. You can measure it out yourself. And that was definitely a bear market. And then it got above it, and it has been above it since. And broke below it back here in 2015 after the highs. The highs were in April 28th of 2015 in Apple. Shortly afterwards, it broke below it, as well as this. Look at this yellow primary uptrend line off the 2003 lows. So this looks like a big, giant bearish rising wedge. If you guys aren't tracking, I'll show you what I'm talking about here. See the divergences, negative divergence, see the volume declining, divergence up here on the RSI against prices right here. It says divergent high here. There was also divergent high here because prices made a higher high. And there's that yellow trend line. So we broke down below there. We've been in a bear market since. Yes, we did recently come above there, but right now we're flirting with that level again. So this is one of the most accurate trend indicators on Apple for defining bull and bear markets. And my point is, right now, going back to this TC2000 chart, we're flirting with that level right now. You see how we're actually below it, or right on it. Looks like we're hammering on it. So today's only, what did I say, Tuesday. We've got a few more days in the week left, so anything can happen. Just watch that level. And again, one week close below it doesn't mean anything. You had a couple weeks here. There was a close above it, a close above, fell back below. It's more of, what Apple should be doing right now, as I mentioned, after this breakout back test. It shouldn't come in and take that low out again. If it takes out that low where it back tested, then it's also going to be below that 40-week moving average. The evidence is mounting that the trend is now that Apple's rolling over this bearish PPO cross, the RSI moving back down. So there's one. I spent probably more time than we should on Apple, but again, it's a pretty important stock for both psychologically and as well as its heavy weighting in the NDX. Here's Google, or Alphabet, I should say. I'll probably call it Google indefinitely. I wish they would have never changed their name. I liked Google. But all right, there's Alphabet, Class A, GOOGL. Just a clean uptrend line here off the 2008 lows. This is one of the big names that bottomed back in late '08. But look how well defined this trend line is. Look at all the reactions on this yellow trend line. And this looks like, and it is, a very large bearish rising wedge. You've had divergences, just like as in the broad markets, forming since early 2014. Just because they've been building that long doesn't mean that they're not going to work because they haven't played out. It's a weekly time frame. These things, their divergences can and often do take many months or even years to build. And the more powerful they are, the more powerful the correction or the trend reversal once it sets in. And what would be the sell signal? A weekly close below this trend line. Again, very well defined. Numerous reactions on that trend line going back. This was a little overreaction. Remember, there was a meltdown in '08, and then we had another meltdown in '09 at the end there. So it's what you can do on candlesticks. You can certainly cut off some of the wicks there. You just try to capture the most reactions, whether it's a body or a candlestick wick, like in that case. And this one is, as far as trend lines go, on a scale 1 to 10, that's got to be up there with an 8 or 9. That's a pretty solid trend line with a lot of reactions and very few trades through it or anything like that. So I can't even say much more to that. That's just a chart that looks like it's ready to pop anytime. And again, this is a market leading stock. There's the other share class. An Alphabet, GOOG. Did I cover the 60-minute charts? Maybe not. Oh, yeah, I need to do that. All right, 60-minute charts. I don't see any bullish divergence at all. In fact, there's not divergence. And there's a mountain of resistance up here around 786. This blue line on GOOGL. Let's go to a 2-hour chart. You can see it a little bit better. So, this one broke down recently. And that was a pretty key support level. It jumped below it briefly, got back above, but fell back below it. A lot of reactions to the left. Big gap right here. You can see the gap to the left. Maybe it wants a full backfill of that gap. We already backfilled it down from below. Now we're below it. And, there's resistance. And if it gets above there, there's also quite a bit of resistance. So this is my point here, is these market leaders have rolled over. They're off their top. They didn't just come in after breaking out to new highs and back tested. They fell through this multi-month. This was that same multi-month sideways trading range I've been harping on with the Qs and the S&P 500 that we've been in throughout, since really late summer, mid-summer, throughout the end of the year. And now we're below that level, just as we are on the Qs. And, these obviously these guys are going to reflect what the Qs are doing. Daily charts, again, GOOG, you can see the divergence, a series of negative divergences. Might have it drawn out better on the other share class. There you go. So this line right here shows you prices making a higher high at this point with all the indicators down below making lower highs, negative divergence, prices finally rolling over. And again, so here's my point. Daily time frame. This is pretty bearish. This little move down right here, this 11% drop, isn't in line or commensurate with the scope of these divergences. These are divergences that have been building since last summer, 2015, a series of negative divergences. And, just the kind of ballparking the drop that you would expect after that. It's a lot more than this. That's all I'll say to that for now. There's Microsoft. I'm jumping all over the time frames here, guys, if I don't mention it. There's a daily time frame. Negative divergence. You can see the divergent high. Negative divergence down here. There's an uptrend line, which Microsoft just recently broke down below and is currently backtesting. It found support right after it broke down. You see a few intraday whips down there, close back up. So here's a couple levels to watch. 58.41 as well as that backtest on Microsoft. And... okay, sorry, I had to pause the video there. I had a brief distraction. Where was it? Okay, so that was the level I was talking about. 58.41, plus it's backtesting right now. So if it fails this backtest, meaning moves lower, takes out that 58.41 level, this is I would almost say a critical support level. There's a lot of support here. 57.80-ish we'll call it. Let's color that orange. And that would be, in my opinion, you can see the divergences again, daily time frame we're on now. That would be the good night Microsoft level right there, below 5680. So, to see it roll over here and drop, I think we're going a lot lower on Microsoft if that happens. And, I don't see anything in the charts to say it's not going to happen. Weekly chart, negative divergence, same story on a lot of these guys. These are the leading stocks. They tend to move together. There's so much money in the queues. And because the way that money, every time you buy the Qs or somebody indexes with the Nasdaq 100, the money goes into these top names. And so they're going to tend to move together. And there's Microsoft from a weekly perspective, quite bearish, oversold, divergences, everything you want to see. It's well above its primary uptrend line, so it's got a way to go. So at the very least, even if you're only looking for a correction, then you want to get long for that big move to new highs that some are calling for. That would be, this is the minimum target down here is at 50-ish level. You can see nice, very nice horizontal price support. I have that zone, and it comes in with that uptrend line. But if and when that goes, then Microsoft's headed a lot lower, probably down to the $40 level at least. Okay, let's go through these a little faster. Not that any of these aren't as important as the others. In fact, this is a very important one. This is Amazon up today. All these guys are rallying today, and this is why I like to do this video. I don't want to do the video when they're down. This is a good time if you're not already short and you want to get short or you're looking to get short the Qs. We're up today. You could certainly shorten the strength, or you can watch these levels. So this is a weekly chart. We were already on a weekly, so I'll just stay there with Amazon. Pretty well-defined trend line, bearish rising wedge, negative divergence, everything you like to see. I've gone over this chart on the site. And this is what I call my high probability target zone down here. It looks to be about, 424 to 440, somewhere around there. There is support there. I can't make out that level around. I'll get to it on the daily chart here in a second, around 700. So if and when this horizontal line goes around 700, I'll see there's always zigs and zags along the way, but I think that's very, very likely to see Amazon heading down there to that 440-ish area at least, and try to quantify it and try to imagine the impact such a market-leading stock would have on the market. That's a drop of 37% minimum, 37, 38%. So I can assure you if Amazon goes down 35, 37, 38, 40%, the stock market's going down quite a bit. Let's see, daily chart on Amazon. Here's we had this little price channel. We have the series 2 consecutive divergent highs. We had a divergent high. You know what? No, this is all one. This is your divergent high right here from this point to this point. And you can see the MACD and the RSI not keeping up, making lower highs. And Amazon has just started to roll over. So there is, could update this chart, but give you a few more support levels. There's that 700-ish level right there, call it 696, 697. And it's got some work to do. These are old levels. I haven't cleaned this chart up, but either way, I see more downside on that one. Now, 60-minute chart, I don't know if I'd dive in right now. And also remember, guys, I didn't bring this up. Standard options expiration is this Friday. And I talk about the OPEX ramps, the tendency for the powers that be to gun the market up, leading up into options expiration, and then the sell-off, which we saw last month and we've seen much more often than not in recent years. That OPEX ramp, and we may see that again. So maybe they hold the market up to Friday, maybe they don't. Who knows? It's not 100%. But after that, if they do, I would expect the selling to resume next week. And these charts kind of almost indicate that, because you can see as I'm going over these 60-minute charts, there are quite a few that have these divergent lows, such as Amazon here. Here's a price channel, but Amazon has a mountain of resistance overhead. This is a big level around 752.50. Let's look at it on the 2-hour chart. You can see here it acted as resistance back here, then it was support, all this area, and once again it was support here, and now we're broken below. So that's 752.42. That's where my line is, and if it gets above there, it still has its work to do. These were just, they're color coded because these were targets. If you guys recall, I think it was a 60-minute chart or a 15-minute chart. Yeah, it was a 60-minute chart. I pointed out this little pattern here and gave these downside targets. They were all hit and then some. So now that 752.42 is a good level to watch. And I think I already covered, yes, I did cover the weekly. Facebook, and we'll just start out on the weekly because we're there. Looks like a pretty well-defined uptrend line here. A lot of reactions, a little weekly breakthrough on that flash crash in 2015. But again, a lot of reactions along here to validate this trend line, and most importantly, this sucker's finally gave way. Been waiting for that for a while. You can see the breakdown there clearly below. If I zoom in, you can see the negative divergence to confirm this high. At this point, the price is making a higher high against the MACD and the RSI making lower highs, negative divergence. These are all targets or potential targets. Horizontal support levels, and I really like this one. This is a trend line that's not very well validated. There's only 3 or 4 reactions back here, but I would suspect that prices come in, and by the time we get there, if we fast forward here, maybe we see something like this. Maybe it takes a little while longer. We come in down here, wrong tool, guys, sorry about that. We come in to this intersecting level down here, but I'll tell you what, prices tend to fall a lot faster than they rise, so nothing would surprise me, and we could come down. Well, this is a weekly chart. It would probably take us a couple weeks, so maybe we get there. Actually, what I could see happening here is an overshoot of that trend line intra-week, come in, hit that 72.90 support level that I have, only to come back and close the week right up here on the trend line, that primary uptrend line. So that would be a nice target for you guys swing trading Facebook on the short side. There's a daily chart. I haven't cleaned this one up in a while, but the most important point here is a divergent high at this point. Long-standing series of divergences, and they finally started playing out, and they most certainly are. And another thing, remember, excuse me, despite any divergences on the 60-minute chart, these daily charts do not look good. What I'm talking about, look at the MACD and the PPO on Facebook, or the MACD, I should say, headed straight lower. There's not even anything remotely resembling positive divergence or bullish divergence. In fact, this thing isn't even curling up yet. You know, if I saw the MACD curling up, maybe making a bullish crossover, that would be one thing. We're oversold, yes, but as I mentioned before, oversold can become, and often does in a downtrend, become more oversold. This does throw a little caution. You do have a stock at support while oversold. So I don't think this is a level to right now be going all in on a Facebook short, but watch that level, 116.50. If it goes, this is your next support or target, 108.23. All of these are levels. That's why they're here on the chart. If you see these lines are all key levels that I think Facebook is likely to visit in the coming weeks to months. All right, we'll wrap up with just a couple more here. Comcast. Here's a huge rip in Comcast, but look at this. We had an uptrend line here, pretty well-defined uptrend line, back testing that uptrend line, also testing the previous highs in Comcast after an extended run. We look at a 60-minute chart, or actually let's go to a 2-hour chart so we can see a little bit better. This run looks a lot like this run here, near vertical run, and that run was followed by, it was too much, too fast, and Comcast gave all that up. So here we are back at that same level. You know, the catalyst there, it broke down. It didn't have an immediate sell-off, went on and push up from marginal new high, but eventually rolled over. Failed to really take out those highs. Tried to do it briefly, tried again and failed, and then just worked its way lower. So either way, you have a stock extremely overbought on the 60-minute and 120-minute time frames, high level MACD, extreme readings on the RSI. So you don't want to chase that one here. You know, price action recently has been bullish. Would have been nice to catch that move. I imagine that was some news-driven event, but either way, there's a stock that looks pretty extended and ripe for a pullback. And then again, bigger picture, what does the bigger picture tell us? Here's the primary uptrend line off the 2009 lows, and we're flirting with it. Comcast just tagged it, bounced. You have this minor uptrend line here. It's back testing. This is your long-term sell signal when we have a solid weekly break, and you want to look at all these break together. Comcast, Alphabet, all these ones that I'm going over here with these long-term weekly uptrend lines. you'll probably see them all break within close proximity. And once you see them all break and close below, then I think it's safe to say that you can tuck some shorts away for a long-term trend trade, in the next move down in the market, and just set your stops comfortably above. Okay, I have to stop it here. This video went longer than I thought. There's probably too much material to cover in one video. I just wanted to kind of give an overview of the markets, the NDX, and all those various time frames, because like I said, I can't emphasize enough the importance of really taking into account all the time frames as well as the top components and just watching them as a whole, to help confirm any sell signals. Because this market, if anything else, if I had to put one label on it, I would just say, it's been a very, I don't want to use the word treacherous, but a very tricky and whippy market. A lot of whipsaw, false breakdowns, false signals. And so that's why right now we need, whether you're bullish or bearish, you want to see a preponderance of evidence. You want to see a lot of stocks, key stocks, all taking out resistance levels, or in all these divergences being burned through. Or if you're bearish, you want to see not just one index, but all the major indices breaking support, printing solid weekly closes, and you want to see these leading stocks buckle as well and break those support levels. At that point, then you have a high confidence sell signal, or buy signal again if you start seeing the evidence firm up on the bullish side. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.